Welcome to this presentation on Forecast 5. My name is Jeff Nightingale. I'm the presenter, and I hope to run you through the purpose of the product and how it works. So, budgeting beyond spreadsheets. So what we're dealing with is products that create budgeting and forecasting solutions. So this is Forecast 5. So if we look at the goal of the budget to assist and validate decision making, so we're going to prove financially that the process or concepts work. Key around this is must be able to rely on the accuracy of the budget. So we are looking to have the things that we see, such as spreadsheets, which is the common issue we're dealing with. Is it right? You know, there's so much time invested in the error-ridden processes around spreadsheets. There's a lot of research about the difficulties coming out with them, and there's a whole range of comments. Unfortunately, if it wasn't so serious, it could be funny, and that's quite the problem. The mistakes are getting bigger and more traumatic and more difficult, where you make incorrect accessions, decisions of structure around these, and then rely on those assumptions, or you don't have assumptions, or you might not have a proper balance sheet or whatever. So many of our client acquisitions are dealing with replacing Excel because they just can't get the work done. 6 scenarios, there's a lot of literature around there, but spreadsheets from hell. There's a good case study of one person who spent a week without sleep trying to find out what was happening, and really they couldn't do it in spreadsheets. And then the analogy to that is that they'd had a purpose-built solution. They could have done this very simply, would have done a what-if analysis, and immediately impacted there. That organization was an $80 million US turnover company, multiple divisions in that. So we've had a range of those, and we come up to Forecast 5, the solution we're trying to present to you today. So error-free budgeting, accurate budget. So it's purpose-built solution around that, and we provide a range of reporting mechanisms that make it very simple to see your P&L, cash flow, balance sheet, funds flow. In addition to that, there's supporting schedules, and there's a range of opportunities around that and functions that we provide to make the whole process simpler, a lot more worry-free, stress-free, by knowing that the information that normally you would have to add into formulas and that is already done. So we have a range of targets. So I guess we fit into an area between $1 million to $500 million. That's based on our current experience. Really looking at the in-house users, the accountants, the chartered accountants for their clients. So the two market sectors are people who are budgeting for their entity, whether it's a corporate, a not-for-profit, charities, or anything like that, versus a chartered accountant budgeting for their clients. And you need an accurate, reliable tool set. Finances are generically worldwide, very little differential other than taxes and all that. So we do have a good range of applicability. Infrastructure clients, corporate SMEs, medium businesses, publicly traded, not-for-profit, trusts, government, any of those sort of types of organizations, anybody trying to do a budget process and needing to get an accurate thing. So, you know, we have yourselves, finance managers, owners, directors, partners, CFO, general managers, all wanting to get into the solution to find that. And you're driven by Excel. Quicker processes, no mistakes. I mean, a very good friend of mine who ran a very large organization said he used to be able to look at the Excel spreadsheet and say there's something wrong. Now, back when that was occurring 15 years ago, there wasn't a lot of tools around. But it's that mistake in an Excel could take hours, if not days, to resolve. So they're always trying to find a better solution, and you usually are doing this under pressure because there's very little appreciation of the intricacies and the sophistication to build a complete model. All right, so we have the types of industries that we've experienced with at this stage. You know, I think we've covered a fair range of the gamut. Manufacturers, we have a purpose-built stock on hand record, which does manufacturing work in progress standard costing. Distributors and servicing, warehousing and wholesaling. Accountants, chartered accountants, we frequently get the accountant partner in 1 month, and then the next part, and then the next training session of the staff to take advantage of it. Agricultural farmers, growers, wineries, vineyards, orchards, what they have is in common is a crop that grows in value. Our stock on hand record allows us to increase the value of the stock on hand until such time we're ready. Schools, driven by roll numbers, returns per roles, student groups and all that, plus the necessity to budget capital expenditure and therefore project it, plus they require to be reforecasting at midpoints in the year. So we support all of those functions very happily. Engineering, publishing, supplements, vitamins, health checks, a very interesting couple of clients there. Huge growth potential, huge growth marketing issues, selling across the world. So we're in currencies, managing the supply chain implication of that. Healthcare, retirement homes. This is where we're no longer budgeting by dollars, but we're budgeting by KPIs or drivers or factors. So we have support for those information, non-financial drivers. Technology solutions and services. The ability to capitalize an expense is something that we handle through a process which allows us the wages in a software development company to be capitalized into the asset. Apparel and footwear, articles, shoe size, all of those sort of things. Retail, cash up front. Logistics, marine, accommodation. So number of rooms, daily rate, number of days in the month, occupancy rate, and all of that leads to the revenue calculation. And there's more that we've fitted in that our clients have dealt with. So variations on winery, winemakers versus wine growers on that. So what we'll do is we'll just come out of here and go into the demo for you. And we're going to start with, here's stock standard opening screen set that we see. At this point, there's 4 budgets in here, and we can create and support as many budgets. This screen allows us to create a new forecast, new consolidation, rename, copy no values as a template, so a blank layout, so I can copy this full budget, have another copy for my branches, delete and all that, and various other little functions on that. So I'm going to assume for today's demo that we've got an entity. Let's take on board, we're an accountant, and that's not what we wanted to do. We were wanting to create a new one. So we'll start again. We'll go down here and go new forecast. I'm in New Zealand, so I'm just chartered accountant or accountant, doesn't matter, financial controller. I've just come up and they want me to do the budget for the next year. So we'll just go Jeff's company and spell it right. So I am not here for my typing. We're going to start this in April next year because that's the financial year for New Zealand. However, if we wanted to, we could start it last year and have our first data period as December 17 or whatever month we want, which would mean opening balance sheet and all that. We can select our currencies and we can select if we're going to integrate any third-party financial systems. We'll just do a generic here. So I want to show you a sort of process around what you may get in real life and the sort of stress levels you would get. So this opens up with a blank forecast template, which is Jeff's company. Okay, so we'll give that a name. I put the pay space there, that sort of thing, and the description. Could be just reason we're doing this. The demo. Now, fortunately, my clients decided to email me in this little budget that he's done up on Excel. So we've got this sales forecast 5, so much per month, the 12 months like that, total revenue columns, right down through to our total profit. Now, I'm showing you as part of a demo to keep it fairly reasonable. I've modified, or not modified, I've formatted this ready for import. What I have done is I've added the sections, services and sales, direct costs. So what I'm looking here is, here's our sales section, and we can add more sections and all that. So just to get this rolling, we're just going to simply select this pre-formatted structure, go copy, hop into here and go into our utilities, and we've got an import function for the record list. So converting an existing Excel to spreadsheet, yes, we are trying to go beyond budgets in Excel, but we do not deny Excel has its absolute place in things. And so we work with Excel. It's when Excel is into formula calculations, trying to produce things like cash flow, where you will always have a big battle to get that right. All right, so that has now brought that in, and it has formatted it along the lines of what I had laid out there. So we've brought in our sales of forecast 5 products as records and that. So just showing where our layout is. We have a section, which is a grouping of records. At a section heading, we can see the records that are in here, so we can see those with values. The section types include direct costs or cost of goods sold, so that's cost of goods sold, overheads, So those are our expenses. And further down here, we format this into our balance sheet layout, bank accounts, fixed assets, loans, capital accounts. And coming even down here, we have certain areas such as assumptions and memo records, as well as our forecast records. So sales assumption number one. Stop doing that, Jeff. Okay, my mistake. We are going to have flat sales this year. Right. So we can record all of the assumptions relative to anything we do there, and under our reportings, we have an assumptions report. All right. So assuming you can understand, we've got these sections, services, groupings, and all that. We then have sub-levels, which are what we call folders. And these folders, you can have 5 levels of folders, plus a direct costs, plus the section, plus a thing called an item structure called a department, which is a sales cost, the sales gross profit format, and then the forecast itself. So giving you up to 8 levels, which then can be consolidated to give you 9 or 10 levels, because consolidations can be reconsolidated. Right, so let's walk through this. What I got given wasn't particularly good because it simply just said revenue. So we have these types of records which have various options that we want to do. So whether we can support it as income, separately invoiced income, or accrued and prepaid, each of those are particular handling methods for accountancy, and obviously an accrued and prepaid record reflects what we're going to do. So, and then how we handle that. So what I'll do is I'll just help this come to place. I just want to close and reopen. We've got Jeff's company there, and that's just going to reformat it after the import more correctly. Now, so for forecast 5 sales, product sales, we will do it as an income. We can bank into multiple bank accounts, and we can change the currencies. All of these are set up under here, under our headings here. So realistically, the details, currencies defined by month, by rate. So I don't know, 0.9. But in addition, we can add any currency we wish. So if we wanted to add the US dollar, we put in the dollar sign, and we put in the acronym, and then we say 0.7, for example, and the opening's 0.7, and that rate is for each year. GST profiles, definitions, and rates are all set here. 15% can be changed by month, by year. Profiles, seasonality spreads, which we can use, our default settings for payrolls, forecast other options, preferences, so we're going to suppress zeros, titles, Jeff's message, reference to our disclaimer, similar like that, and then parameter defaults. So whenever I create a new record, I'm going to make it 5 days seating, and we pay our creditors on 25 days, and stock is 90 days, and straight lines our method. So these defaults will apply that when I go in here and I add at this level another section, because we forgot to do the international sales. Simple as that. There's my international sales, add a record, and we will do that in US dollars. I'll get a warning that it's in the wrong bank account currency, and I'll show you how to handle that in a second. So we'll change that to a separately invoiced record, and we'll just literally fit this in as US forecast 5 sales, and we'll come down here into our bank account. Now the bank account calculates every time we go near what a system record is. We calculate and update the information for interest calculations, tax, GST, any variation on information that is happening. We'll add another bank account just for purposes here. So this is going to be called the US dollar bank account. It's going to be in US dollars. USD, change this to USD. Incorporate our credit interest rate at 2% and overdraft interest rate at 12%. So that's by month and figures like that. So we have a range of information around there. Now, US forecast sales, we've seen the choices around there. We can also record and map our general ledger code or project code or estimated code. And we have over here called a what if multiplier. Let's remove GST because obviously that does not happen. Now we fall into the ways we want to budget. So we have a various selection of methods that we provide to make this very simple. Let's do calculate from units. The price is $12.50, and we're going to sell 25 units a month. And immediately it's calculated out there. You see that it defaulted to my 5 days. We might not have 5 days. We might decide that our cash flow options could be days credit, payment profile, because on general we expect 75% up front in the next 25 days. We'll see how cash flow is modified. Monthly, 2 monthly, quarterly. So now suddenly not only do we calculate the profit and loss by a range of derivatives or methods, we also are managing the cash flow. And this is per record. So each record can be set to its own control. And you'll see here we automatically are creating the trade debtors account for US forecast sales because it's separately invoiced. And we can bank that into the US dollar account. So it's too hard to see that. So we'll do 100 a month. So that makes the numbers nice and round, 125,000. And that will go through. Right, so we can walk down further a little bit into our different services, and we can specify that there are different ways. So training. Training has a unique function around it. It's based on the number of sales, maybe. So what we'll do is we'll add a record called units sold, and we're going to select that from what we put in the top there, which is our US sales units, and we see our 100 per month. Now we're going to then say is add our record called training people. And we're going to make that a formula. And the formula is available throughout, and the formula is the units sold. So that's down here to our units sold times, and I'll just put in 0.75, we'll add that. So 3 out of 4 are going to attend a training course. Right. So these memo records are very powerful. You can create memo records like we have for liters moved, units sold, assumptions there. Sorry, that's the assumptions one. I can add another record in here, and you can see some predetermined number of days, sales units, cost units, number of employees. So if we had employee wages record, hot link and formula. So just flavoring this up, training revenue is now going to be based on a formula itself, which is the training attendees, training people times $450, add. And we can add as many combinations of this formula. All right. So what we might need is we need to build up our model a little bit. We might add our assumption. And that's based on 3 out of 4 attending. Okay. So obviously you can see we continue to develop that. So just moving through quickly now, a stock style report, a stock type record. So we have in the cost section a few more options of record types. So we'll just do a simple stock. All right. And what we're just going to say is our cost of sales, which is stock, is a percentage of sales of these 4 records or 3 records, right? And 50%. We only want to hold 30 days stock on hand. So you can see the derived purchases requirement to make the stock on hand figure equal what we've decided there in our payment terms, 25 days. But notice there that the annual license fee is actually a percentage of sales. So you can see here we've got percentage of sales, cost, wages. So because we want to do that like that, we can select these records and make that 20%. In the US, we'll add a record, and that'll be annual license fee. And that again is going to be a percentage of sales, but just of the US sales. Change it to US dollars. Change it to 0%. You see the prompts where things need to be amended or considered before you do there, and we'll get 15% on that just because we've got margins. Right. So that's stock sales commission. We can build that as a formula, or we'll show you in more down here in labor costs. We'll bring in some staff and that. So let's deal with some of these other records just to fill the model in. Rates and water. We know that's an accrual, and it's a prepayment, actually, not an accrual. We pay it in advance. So what we'll do is we'll set this up as a prepayment record. simply say we're going to have $500 month cost, but our invoices are coming in quarterly. Simple as that. We now recognize correctly an accrual or prepayment. We prepay it up front, we expense it $500 and manage that. Now let's deal with labor. Wages, records, wages and gross wages are two types of records. One does from gross down if you use a simple model, which is just enter in net wages, $10,000 a month, $2,000 of PAYE or a percentage. However, the most commonly used option is what's called employee groups, which is that. So you can have as many wages records as you want in there, so we could put them in as cost of sales, but we could say our sales reps, and we've got 5 of them, and we give them a monthly retainer of $3,000. They're on KiwiSaver. You can see start and finish dates there, so you can bring on new groups, but we'll go into the bonus factor, and we'll just give them a commission on all of these sales. We'll budget for 2%. Get on there. Right. So very quickly, we've got a 2%, we've got an increase, and we could throw out a Christmas bonus of 10%. We'll see this 4.8 jump to 5.1 because we've taken that on there. So that's the sales reps, and that's just what we call employee group. But we can add as many groups. So we might have the manager. And it's just one of them. He's on a base salary. And I could add more KiwiSaver combinations very simply, but you're seeing here that the PAYE has been calculated instantly for every record. All right, so that's the there. We might want to add another record, which is the admin costs. So you'll see there it automatically assumes the properties of the record above. We'll do that as employee groups. We've got the employee entry, we've got the accountant, and we'll do that salary 75 KiwiSaver. All right. Moving through this, we can budget our vehicle expenses, and each of these combinations can be entered to fit the type of record. So if we said something like from employees insurance, let's take that and we'll turn that into a percentage of wages to reflect just ACC. So we've got 2 of those costs selected. We've got 3%, so you could do wages like that, and we can just change that literally to ACC. And change our GL codes and mapping. So moving further down, so obviously you can see how very simple it is, A, to import a record list, making it very easy to convert an existing client, get them in place or whatever, and also add and update it. So we've got a rental income bank accounts we've seen. Now let's look at our fixed asset or our balance sheet. All right, so we've got plant and machinery. All right, so we've got nothing in the opening balance sheet. So up here, we've got our opening balance sheet. So we can click on that and bring in the existing structure. If we're integrated, we can import the opening balance sheet based on a date function. Firstly, before we go there, the system calculates the records. It then pops up a very easy screen, which is capable of being exported and brought in there. Let's say we had $50,000 of buildings, $25,000 of plant, $10,000 of equipment, $25,000 of cars, et cetera, et cetera. What I might do, because this is just getting too much for me, I'll go over here. You can see I've got one already set up, so I'm just going to go copy. I go back to forecast 5, and that didn't take, so we'll go back there and we'll go copy again. Now we then go back here and we import. Now this won't perfectly match because obviously they're different formats to what I've been adding, but generally we've got a lot more plant and equipment depreciation than we've got plant and equipment, so we'll just tidy up some of those. And you can see our main bank accounts opened up. Any of our US forecast sales, we had some trade debtors, 450,000 or whatever. US debtors, we can load all of those, GST for debtors. This is down to our liabilities. So I'm going to take that out there. We'll start with 0 and we'll put it in as we start with an overdraft, 250,000. We can continue down. We have a GST library of 25,000. We have a PAYE liability of 15,000. Similar down. Bank loans, we need to annually. Now you'll see here we introduce our capital. And to make life easy, we have some processes which is called auto balance. So we can take that entry, auto balance the retained earnings. So that's getting the opening balance sheet in. What we'll see now is it now populates that data. So imagine it's just put that in and it's immediately calculated the depreciation at 25%. That's a bit high for plants, and we'll drop it back to 20%. We were dealing with this, and so we know we're going to spend $75,000 on plant in July, and we might sell some of the existing plant, $50,000 worth, and we make a loss minus 10,000 or 5,000 budgeted. Anyhow, simple like that. So you can see now you've got CapEx budgeting and all that. We might also determine, on the motor vehicles, we're going to add a new vehicle, but later in the year, and we probably will add that as a financed asset. So we support different types of assets. So this is both the loan and the fixed asset itself, and this can cover anything from a lease or onwards. So new car. We're going to do this in November, and it's going to be 36 months. It's going to cost us $50,000. And the interest rate's 9%. Okay, immediately we've given the calculations for the loan repayments, the depreciation, the disposals. We can see here where we want to put the depreciation and a range of other things, and we can handle a deposit, all right, of $5,000. And that will reduce the repayments. So you can add all of your capital expenditures. All right, loans themselves. Now this is borrowing. So the entity has had an opening balance sheet loan of 48 months to go with 125,000, interest rate of 7.5. These are the repayments. The new loan, unticked, puts it into the opening balance sheet. So the balance sheet will just have gone out. However, we've got choices between compound and simple interest, payment frequencies, quarterly, monthly, annually for this one third, similar things like that. All right, so you can bring there. Now, part of the process we've been doing and the things that you now see, we've automatically done our bank, our debtors, our creditors, our GST, our stock, our accruals, our prepayments, our loans, our assets, all those ranges that we just looked at. There is a section here for any other records we may wish to include. So that's fine, and we can give them any name and any supporting type. All right, so I've covered off capital account itself. There's capital reserves and capital revaluations that are capable. Memo records, this is where we put in the memo, might be the units, the non-profits and that. And so if we put in the units sold, like I've got that there, slightly than that, we are also capable of printing that on the P&L after the gross profit or after the net profit. Training people, I'll do the same. Right. We've seen the use of assumptions. And down here at the section here, we've got a section called forecast records. So first thing we needed to deal with, we've put in our opening debtors, but we have not assumed how that cash is received. So then we go to the opening trade debtors record, which is the same one here and there. System does a recalc. And we've got our trade debtors, and we didn't put an opening balance. Silly. Well, we'll put one in here. I didn't hold it. And we expect to get that 300,000 and 150,000. Oops. Okay. So we're expecting obviously the money there, and the same with our creditors. So we've got to assume how to handle that open situation. Just say we had 125. And we pay that all out. Or we could do it by days entered or any of those profile functions, right? All right. Further down here, we've got a couple of things that are important to budget in. Income tax. Let's budget the New Zealand 28%. And we see that we better pay the IRD, its share. We put this in to make sure we reflect this in the cash flow, because it's not much use budgeting it and then not recognizing we have to pay for it. So that leads us down to paying them, and then we can actually budget in some dividends if we so wish. So we've got 40% net profit after tax is more effective. Let's say 30%. See how quickly it calculates, and we're going to do a payment of 380,000 in October and 250,000 in March. Down the bottom here, we can introduce provisions for bad debts, obsolete stock, and these system records tell us our figures. So our PAYE record reflects the activity that we've entered in the wages. Okay, so let's have a look at some of the things we've got. From the heading top there, we've got what we call the quick view, snapshot. So I do show refresh, and it will give me a quick snapshot of the overall data entry leading down to our profit after tax, and our balance sheet presentation, that. If I drill down onto a sales section, you can see the records and sales. I can double click on that record, and I'm inside that record now, and I can change any number, any daily figure, or any weekly figure, and any terms or conditions that I want for those figures. So there's just some very easy way to visualize and see the data. You'll see that our presentation gives you the entire information of that record. When we add show system data, we will get further information as to tax received, net receives, just that information that we hold on there. Yeah. So following through from this, we've done our model firstly. So let's have a look at our reports. So we'll go to so in order to make sure all of the figures are correct, we do this final calculation so that when we run our reports. So we can look at our forecast figures. We do a show all because that's the simplest way to see them all. And all 4 core reports will be run for us. Yes, we know it was out of balance because I did some entries. We'll just do an auto balance. That'll allow us to run cash balance sheet and the other 2 reports. Now, here's our profit and loss. Sales, revenue, cost, international sales converted to New Zealand dollars, total turnover, gross profit. There's my figures for stats, units sold, training people. There's my expenses, total overheads, depreciation into its own depreciation section, or it can be guided into individual sections. Leading to operating profit, leading to interest income, leading to interest expense. That shows me I didn't put into the main bank account an overdraft interest rate. So we'll just drop that in, 8%. We'll have a credit interest rate, 2%. Looks like we're running in a bit of trouble there, so let's just check the figures that we've got in the US dollar bank account. And let's transfer out $1 million in November. Go back to our main bank account, we'll see this, recalculate that, and we bring it into line. Maybe we should have done October. Now, that's change, obviously, means that we should probably refresh our reports because there's a significant difference now that we've added an interest cost in an overdraft situation, and there's our interest on the main bank account, overdraft interest, our bank loan interest, leading us down to income tax provision, profit after tax, and dividend, accumulated profit. We can display this report quarterly, annually, all that sort of thing. Cash flow. So here it is, cash is king. Where's my money? Show me the cash. There it is. So we're going to end up with this sort of movement, the total movement, and the final closing bank account. The cash flow report can be run by bank account. So that was a generic overall run, which is all of them combined. Individually, this is just the US bank account. A balance sheet. So that's going to show me all of my relevant balance sheet positions through to creditors, liability, motor vehicles, cars, all of those sort of things. You've got a rounding error for $2 at the end of the period, or $3. That was just nothing inconsequential. The balance sheet, that balances. But more importantly, we can see the funds flow. So like the cash flow shows you where the money came from, the profit and loss, the funds flow shows us how it was applied. And this is what you'd call a four-way structure for presentation of financial reports. Source and applications, funds flow, the balance sheet, cash flow, and profit and loss, where it came and where it went to. All right, so then we've got a range of those. So just very quickly, my assumptions report, that can be then printed. All of these reports printed straight from here or exported to clipboard and pasted into Excel, and they are going soon to be one-touch reporting into Excel. Employee schedules, this gives us a list of the PAYE forms or the wages records that we've set up, GST schedule. All of this you'll notice we've done just simply as a product of entering the data the way we want it. So in this 30 minutes, we've generated our forecast. We can see our sales visual. We can see our bank movement. So here's our sales, net profit, targeted figures, our crosshairs as they're called. We can look at our net bank position as a graphic and include those. So that's improving all the time. Yeah. All right, so that gets us to stage one. Here's the budget. We can take it out. My client's now happy. We can send it all of them to that, put my disclaimers and similar with it. While I'm doing this, I might just simply decide, let's make a three-year forecast. So let's do an extend and amend. We'll make it 3 years. We'll add in a 5% price increase and a 5% volume increase. The costs are going up 3%, overheads 4%, and list wages are going to go up 1.25. Oh, not that much, 0.5. Bingo. Now, what this is going to do, two-step process, is going to take all of those figures, extrapolate them with these percentages applied to them, and create a 3-year forecast. And obviously, very simply now, all of my cash flow, net funds flow, balance sheet reports are all calculated, ready to print, and my visuals there. So there's a little bit of an exercise. We support up to 15 years, but the process gives you that accurate report. And once that's done, we will need to later do a system record recalculation. So if we just hop up here and look at forecast 5 sales, we see our 50, moved out to our 52.5, moved out to 55 as we've added that 5% each month. Our reports, now our multi-year reports, we can produce those in quarterly or annual presentations. So each of the reporting functions will apply the same way for all of those. So a little longer to calculate because obviously it's now 36 periods for all of the data sorts, cash flows, and everything else. So that's one calculation at this is when we do it. We'll do a show all, and you'll see how quickly the reports present after that calculation. And let's look at our profit and loss by year. And the grand total, our cash flow. We can do that by quarterly. And so we see our quarters, etc., etc. So that's the first, what can I do with my forecast? I can also unextend it, so I can bring it back to 1 year. Simple as that. Go OK. It will recalculate it backwards and it'll just remove it and go no problem. Back to 1 year. Right. So next thing we might want to do is what if? What if our sales go up 10% as just a display on this 15,000? So what if the overall sales go up 5%? So we've got a section multiplier, a record multiplier. All right, so we'll make that 10% because that's going to be easy to see. So it's going to go up 5 to 55 plus 10, another 5.5, so 60-odd thousand. I can see that what if here, 57 or whatever. I can now go to my reports and the same thing. All of my what if, all of my profit and loss reports, balance sheet, cash flow, funds flow are recalculated and available immediately from here simply by clicking what if, profit and loss, or cash flow, or show all, or anything. So all of these are presented to you, ready, working, functional. And we can save that was the budget. We can save it as a new forecast, or in this instance, we'll just reset it. Okay. So the last sequence of that, so that's just reset all of those numbers. And so the last couple of things we will show is the entry of actuals. So I'm just going to close this. I'm going to decide one. I want to make a copy. Just company number 2, that's just for ease. Simple name. Now that is going to take a complete copy of the scenario. So I could take that and do a separate what if. I could do anything I want to it. I could set it out to a 5-year budget or a 10-year budget. It takes a few seconds to build that information, but it is an entire solution ready to run. If I'd chosen to use the copy forecast no values function, it would have been blank numbers in here, but all of the structure. Okay, so what I'm going to do is move to actuals, just to demonstrate two or three things we do around this. The first thing we're going to do is, in the actuals, once that is turned on, we're then presented to enter our actuals. And that is a simple process of that. So the actuals is now at the moment creating a snapshot. We have our budget, and we now have our rolling budget. So in the first month, that is one and the same, but in the second and third months, we can reforecast that. So once this is completed, we will be able to enter the actual figures and also enter and create the rolling forecast. So let's start with a rolling forecast. Selecting sales there. Firstly, we can see that. That is my actual budget. I'm going to budget 57.7. Well, sorry, reforecast 57,777 per month going forward. I can't change my actual figure. Well, I can, but it's not turned there. I go to my enter actuals, and that will allow us to enter or import or integrate, whichever the three choices you choose, the actual figures. So while it's going on, you'll notice a chat screen. Feel free to put any questions through that chat screen, but let's just drop in here 5111. I have the same export and import. On the balance sheet, we'll just do the one change for the actual. On the balance sheet, we'll do a little bit more. So we're going to say as our debtors ended up at 200,000, and our main bank account ended up at 250,000, and our creditors were 0. This is going to have to balance. So it's going to ask me to balance, which you would normally have taken your full balance sheet. You can, as I said, you can import it or whatever. So you have three options: manually entering it, importing it from Excel, like we have the same process we've already shown, or an integrated solution with one of the products that we've integrated where the red data is read in. Okay, let's look at my rolling budget. So we only amended one rolling figure. You could have amended the whole lot. You could have your... So we've got our actual month, 51,000, and we've got our projected month. I can compare that to my original budget, profit and loss. All right, and so that will give me the 50,000 flat. I can do rolling budget for cash flow, balance sheet, all in. More functionally, here's my variance report. So let's do the show all of the variance reports. And I'm selecting all the bank accounts for ease. And I've done them against the rolling budget because that's what I had highlighted as the option, but there is no difference in the first month. So profit and loss, actual, variance. Balance sheet. There is some variances in there because we entered some different figures around the numbers and that. But if we look at our cash flow variance report, which sort of makes it very interesting, we've got variances on trade debtors because it's 300, 118,000 positive, negative variances on the creditors, giving us a variance on cash flow and equally variance on funds flow. So very strong. So the process will continue on. We'll go into actuals again. So we'll move it into May. So that's the key function I want to do just to demonstrate that. We'll change this to 6666. We won't worry about any of the others because the balance sheet's now going to automatically come back to the original budgeted figure. So that's going to create some variances because my opening debtors and closing debtors. So that's going to go okay. We can recognize that. You'll see now, my mistake, sorry. The process involves changing the months, which I didn't do. So we'll just change that back to 5123 and we'll flick this over to May. May, yes, we want to go into May. Should remember that. And what we'll now do is make the actual 666. And we won't bother with the balance sheet, which will come up with an automatic balance on us because it's gone back from the figures that we changed. And we'll see this May month now become bold. 2 months there. Okay, so once that's finished, we'll go into our reports. We'll just clear all of those, close all. Okay, so obviously I could revise my forecast, but now I can report against May. One too far. Show all. And yes, the bank account. And we'll see here the variances in the rolling budget. If I wanted to report this again against my original budget, I select the indicator here, I run the original there, I'm back to 50 and 100 versus now what is going to be 107,000 with the actuals. And if I run the rolling budget, I can see the combination of actual and projected sitting in the forecast. Okay, so that brings sort of the last couple of stages. What I'm going to do here is just reset to no actuals. One of the things we get when we do that is do you want to keep the actuals as a budget? So when you move into the next year, you keep the actuals as the budget versus you can revert to the original. And the reason why I did that is I just want to show you the consolidation process. So we go open, new consolidation. Couple of things. Firstly, the start date has to be correct. April, so we can see here, starts in April 17. Did I? Okay. So we'll go back to April 17. We can tick on that one. And that should be the same because it's a straight copy. We can amend the currency of each of the forecasts. So if that one was Aussie dollars or UK, we could import them and consolidate them and update the exchange rate. So we go okay. Consolidation is very straightforward. It is the adding together of these two forecasts. Any records that are identical in name will be merged. Any records that are different will be isolated. So we give this a name. Just consolidate. Sorry. I might just rename that there. Take off the caps lock. Makes it look a little better. We go okay. We'll open this game now. All right, so sales, consolidation, forecast 5, 101,000. Jeff's company put in 50, and Jeff's company 2 put in 51. All of the reports apply. All of the functions apply in the essence that we can consolidate actuals, we can consolidate what ifs, we can consolidate consolidations, and we can do the graph there. The information isn't editable, but you can actually open at the same time Jeff's company 2, and you'll see that show up along the bottom there. So you can have as many consolidations forecasts. We do support the recalculation of the bank figure at the top level. So at the moment, sitting looking at these, it's calculated by the consolidation. And we also handle the fact that you can therefore introduce an overdraft rate at the top level and recognize out the overdraft and net solution between some trading operations. And you can also recalculate the tax provision at this level. Otherwise, it's a sum, 28%. Which recalculates, and then we see we've got that amount of tax. Right. That brings me pretty much to the end of that consolidation and the process we've done there. So what you can see is going well past what anything in a spreadsheet can do in a very short time, some 40 minutes, got a reasonable model from scratch or from an imported spreadsheet, and we can very much do a lot of things through copying. We've now got 2 copies. We can very quickly have a 5-year forecast and whatever. So it allows you a lot of ability. I'm not concerned about the calculations or checking the formulas. I run the reports, I validate them, and they are there. All right, so it's very straightforward and very time-saving product. Right, so just to wrap up, Forecast 5, we are a purpose-built software that takes you beyond spreadsheets. So multiple budgets, we have everything from currencies, stock, wages, banks, all those things I've shown you, out 15 years, departments, up to 10 times faster, if not more, because we're not fighting the spreadsheet all day. We don't have to look at that, we have to deal with it. So forecasting and cash flow. So understand the purpose of budgets. Point in time, we have a comprehensive budget which is a complete solution, including the balance sheet and the funds flow to analyze it. Cash is king. We can easily import and export of data, actuals and rolling forecasts, multi-year, multi-currency, things like that. It has been used for just everything you can imagine at various ranges there. Some stats that build around this. Best-in-class purpose-built software users. So Aberdeen report on a bunch of 500-odd companies. 89% of those best-in-class are using purpose-built software. The average is 49%. The revenue accuracy in best-in-class is 4%, within 4% versus the average of 11%, and costs are within 4% versus the average of 14%. So if you take the extreme, a best-in-class with a purpose-built software solution is within 8%, 4 plus 4. Without it, spreadsheets or whatever, you're potentially 25% out. And can you afford or manage that inaccuracy on those things? Look, yeah, users, rugby unions, apples, pineapples, training, childcare, blueberries, cars. It's just really suits anybody. And just to the type of thing we're doing. Schools, Judith, yeah, essential tool, statement of income. It just made her life easier, and more she's evolving the use of it, because it is so easy. There's Richard Cohen. Certain that it agrees. There was one I used to have, which is a banker that has said, there's nothing more important than nothing more better than a purpose-built software. So the purpose 50%, I must find out what. That's because they're a Wind Forecast user, so we've picked up on that. Yeah, Anthony Pratt, very good. We sell it as a single user network license. You add network for multi-users, consolidations, you can add additional users and administrative pack. So that's if you're a large organization, you've got large users, you can restrict who can see which forecasts, processes like that. Similarly, with whether that's a chartered accounting firm, like the branches from KPMG or PW, or an organization with sales groups and departments, and they want the divisionals there. So bringing this to it. Okay. We can do through things. So the type of integrations, I've just been asked how the integrations work. The process around integrations, and this is applicable to each product, is firstly to read in the chart of accounts and create the record list. So that's like what I imported, but we actually will read it in from 0, stage 50, stage 300, and X and Y. That creates the forecast and links the GL code to the record code. What you're then able to do, while we're doing that process, we also import a selected date range of history. So we bring in the historical data. We then allow you to edit that data, and the process we advocate is you then extend the forecast 1 or 2 years, depending on which years you're forecasting, based on the historical data using the uplist. You then remove the first year, and then you import the balance sheet. So now you have an entire budget with the correct figures from the balance sheet. This is all nominated by date. Now, having done that, we can then import the actuals, both the P&L and the balance sheet, and we can continue to reforecast and report the ongoing actuals throughout the year to record those variance reports. Or in some instances, we've done the reverse. We've submitted the budget back into their reporting packages, their information-based system, and provided that to be updated subject to their. So either way works, but it actually allows them to benefit from very simple budgeting process. With that, thank you very much for your time. Hopefully that has encouraged you to take your budgeting beyond Excel or move into a comprehensive solution. We're very aware of some of our competitors are not full solutions and therefore don't provide something that you can rely on to the accuracy of knowing that, for example, one of them, you can't forecast capital expenditure. The other one, to create a finance record, you have to create the asset, you have to create depreciation rule, you have to create depreciation, you have to then create the loan, you then have to create the loan interest rule and the loan payment rule. None of them are controlled. But that's something that you'll experience, and hopefully you find that. Product of evolution, we're hopeful to release export functions straight into Excel so that you can take advantage of Excel formatting, where we are getting better in that with Thank you very much. Feel free to make contact with us.